Newell Brands stock down 5% this morning despite coming ahead of analyst expectations on the bottom line for earnings. The company off the highs of the past year after reaching the highest level since 2018 in a recovery story taking place during the pandemic. Let's bring in the president and CEO to talk about what comes next. Ravi Saligram is with us this morning. Ravi, thanks so much for joining us on the TD Ameritrade Network.
Our pleasure, Oliver. Thank you for having me.
Thank you very much. Let's start by looking at this quarter specifically. Ravi, as I mentioned, the stock is lower, but a lot of these numbers came in better than what Wall Street thought, whether it's total sales or the earnings per share. It seems like the recovery story and comeback trends that your company has been putting together are shaping up. So walk me through what you're most proud of here for the quarter.
Yeah, I think to me, I'd look at it sort of as a first half, second half story. Oliver, I think this first half we were down 9%, but the second half, the core sales for the company grew 6%, and we grew in the fourth quarter. 6 out of our 7 businesses, 7 out of our 8 businesses grew, which was terrific. The only business that was soft was writing. But even that, we're beginning to see some consumption improvements, and it's really related to the pandemic as people, the schools are not open nor our offices. So the EPS was great, and then the highlight was the $1.4 billion of operating cash flow this year. I think that was tremendous, significantly higher than the billion that we did last year. Our net debt has come to EBITDA has come down to 3.5. So on every measure, on efficiency, we reduced our SKUs. They're down almost 50% versus the last 2 years. We've cut down on the number of ERP systems. 95% of our sales will be covered by 2 ERPs in the next couple of years. So our productivity was just fantastic, 4% of COGS. So I think, and in the whole year of 2020, we took down overheads by about 100 bips, $161 million. So I think the turnaround is really happening, and I think we're well poised as we look at the future.
Ravi, the leverage ratios and the ability to keep paying down about $5 billion of debt, to your point about free cash flow, does seem like one of the most important things for investors. And I want to talk about that, but I want to first also just kind of set the stage for products. When you say you dropped SKUs, that means products that are no longer going to be offered. Walk me through what you want to focus on going forward. What's the strongest component of the Newell Brands revenue stream right now?
Yeah, so when I talked about the SKUs, Oliver, we had more than 100,000 SKUs. And when you think about some of our biggest customers like Walmart, they carry maybe 5,000 SKUs. So it's just, we had way too many. And so what we've done is strong analysis on where's the demand for those and taking away SKUs, which, yeah, if you have only few $1,000s worth of sales on a $10 billion company, it doesn't make sense. So we've been rationalizing the SKUs which have consumer offerings, not brands, but SKUs of individual brands. So I think it's really an efficiency move. So our revenue per SKU has significantly improved in that regard. So in terms of, so let me just leave it there and see if you had a follow-up on that.
Well, Ravi, what I'm curious about is, do you see the SKUs and the overall product suite right now as one that is going to do better as the economy recovers, or one that has done well with food items like Rubbermaid, as people have been cooking at home and living at home? I imagine some of that has brought some demand in for products that people hadn't needed, but now they do. They're living in homes where they are being more residential. They're building families. But then on the other side, as you mentioned, the school products, writing. Those are things that you probably want to see more wholesale style demand for schools. So do you see things getting better as we reopen, or will you lose some tailwinds that you got during the quarantine?
A great question. I think a lot of these trends, especially on the kitchen products, whether it is small appliances, whether it is relating to food, you've had the advent of the home chef, and it's gone from hobby to really becoming home chefs, and I think there's great interest in it. We're seeing continuing consumption growth. Take Rubbermaid Brilliance, great product. We just introduced Rubbermaid Brilliance Glass. That sub-brand doubled in 2020. So we see that momentum carrying on in 21. And then our commercial business, which has focused on the washroom side, and on outdoor and on garage, and we've just had tremendous traction. We installed 3.5 million dispensers, and that can wash like 30 billion hand washes. So I think people are more concerned about sanitization since the pandemic. And then you think about, when you look at outdoor, we brought a lot of new campers in. So that is going to have a positive. I'm very pleased that in this year, Coleman, in its 120th anniversary year, actually had growth. And so I think that'll continue on. So each of our brands, not only have we leveraged consumer trends, but we're innovating, looking at the needs of consumers and coming out with things. So take iced coffee maker from Mr. Coffee. That has just been a gangbuster. It's now in many of the customers, the #1 SKU in that area. So we think that these trends will continue. And the positive is that the writing business, we expect when schools reopen, and we expect them to reopen this summer, that we'll have a back to school normal season. And yeah, offices may not open, so that could be a little headwind, but our writing business is very strong, and we're innovating for the future. We're looking at digital products. If more people stay at home, how can we cater to that as well? But when you look at our writing business, our Sharpie S Gel, this one that I love, gained huge share. We just launched it. We got 900 bips of share in the gel category, and we increased share in pens as a whole. So it's innovation is the key, and we're really driving it.
Ravi, going forward as it pertains to, again, that use of cash flow, paying down the debt as a priority, cleaning up the balance sheet, how much of that depends on a margin expansion from here? What will be the connection investors should be looking for in your ability to keep paying that down? Do you need margin expansion, and does it make its way towards that debt payment? Is that still your priority?
Absolutely. So a couple of ways it's going to happen, Oliver. One, we're saying we guided this year for 21 that we'll have low single-digit sales growth, core sales growth. So that is the starting point of everything. We said operating margins will increase. We guided 30 to 60 bips. We have an evergreen model which says every year we're looking to grow operating margins about 50 bips with a focus on gross margins, as well as focus on productivity to overcome inflationary pressures. So when you've got your operating margins down, and we still think we have headroom to continue to reduce overheads. We made great progress, 100 bips down in 20, but we think we can continue that. So all of that, I think, will really help us drive EBITDA. So there's two parts to it. Increasing EBITDA, so on one side to get that net debt to ratio down, but also reducing debt, and that is a priority. So we are already at 3.5. Our goal we've set is at least to get to 3.0. And so as we increase the EBITDA, get the debt down, I think we're in good shape. This is a big focus for us. And then it opens up possibilities as we look at capital allocation down the road.
Okay. Ravi, looking forward to following along with you, and I hope you come back. Really like the details here on the numbers. Very helpful, and looking forward to following along. Thanks a lot for joining us.
Thank you so much for having me. Appreciate it. Have a great day.
Thanks a lot. Ravi Saligram is the president and CEO at Newell Brands. Shares down today, but still a compelling case for recovery and paying down that debt load that weighed down the shares in the past.